It's about finding that sweet spot where you have enough properties for diversification, but not so many that they become unmanageable. And after years of doing this, we found that there's a balance that tends to work well. For most of our clients who have around this level of cash to spend, that sweet spot tends to be around 3 properties. And here's why. With £200,000, you can put roughly £65,000 into each property, giving you enough for a solid deposit and cover your costs. That way, you'll end up with 3 properties worth roughly £200,000 each. If you're used to London prices, that might not sound like much, but we invest in fast-growing parts of the country where a £200,000 property can be at the very high end of the market. And if you sign up to our email list in the description, we'll share which of those areas we're focusing on right now. This approach gives you enough diversification to spread your risk, but keeps your portfolio manageable and focused on quality over quantity. Remember, your portfolio value matters far more than the number of properties, and quality always wins in the long run. Now, of course, this number isn't set in stone because there are other factors, which brings us perfectly to the next crucial decision you'll need to make. Years ago, I bought several properties in Hull, thinking I was getting ahead of the market. The numbers looked great. The potential seemed obvious, but I was far too early. The growth I expected just didn't materialize, and for years, those properties just sat there, barely moving in value. Thankfully, I'd also invested in other areas that performed much better, and this taught me a valuable lesson. When you're investing £200,000, there's a common belief that you need to pick the perfect location, the one area that's going to outperform everything else. I've seen countless investors get burned because they put all their faith and money into a single location that they were convinced was going to boom. But the reality is, different areas perform differently at different times. Some years, city centres outperform everything else. Other years, it's the commuter towns that see the biggest gains. And sometimes there's a city that seems to have everything going for it, but then it's its neighbour that ends up getting the growth years earlier. This is where having £200,000 to play with gives you a unique advantage, because you have enough capital to do something that most investors can't. You can actually choose whether to concentrate or to spread your investments. Both approaches can work, but you need to know why you're making that choice. If you're doing a lot of the management yourself, keeping properties close together makes perfect sense. But if you're setting up a hands-off portfolio, then I'd be more open to spreading my investments a bit more. And you can mix up city centres and commuter areas, or even between houses and flats, to diversify even further. So you don't have the pressure of making a big bet and getting it exactly right. The great thing is, this can help you to avoid that analysis paralysis that keeps so many investors stuck on the sidelines.